All right, let's jump right into this explainer. Today, we're going to treat the stock market exactly like what it so often feels like, a heavyweight boxing match between two completely opposing investment philosophies. On one side of the ring, you've got the fast-paced trend followers, and on the other, the incredibly patient bargain hunters. It's this fascinating battle of human psychology, market mechanics, and honestly, timing. We're going to unpack exactly how these strategies work, where they completely fall apart, and most importantly, why the rapid-fire timing of momentum so often absolutely crushes the agonizing weight of the contrarian.
But before we dive into the hard data, I want you to ask yourself a question. Think about your own habits for a second. When the market is surging and everyone is buying up a hot new stock, do you naturally want to jump in and ride that wave with the crowd? Or, when panic sets in and everyone is aggressively selling, do you feel that urge to be the lone wolf? Stepping in to buy when there's blood in the streets. Whether you realize it or not, your natural instinct actually aligns you perfectly with one of our two contenders today.
So in one corner, we have momentum investing. Rather than citing market patterns, this approach operates on a really simple assumption. Champions are just going to keep winning. It relies on the sheer force of market flow. I mean, think about it. When a price shift gains speed, it acts almost like a magnet for other market participants, which literally thrusts the price even higher to capitalize on the immediate present. Momentum investors just go with that flow. They leverage the mechanics of an upward trend to maximize their capital efficiency. Now, in the opposite corner sits the contrarian. And look, this isn't just about being a rebel for the sake of it. This strategy banks entirely on human psychology and our chronic, predictable tendency to panic. Contrarians intentionally step in during those moments of high stress, betting that today's so-called losers are actually just fundamentally mispriced victims of market overreaction. They fight the current, they bet on a long-term rebound, and basically, they just wait for the tide to eventually turn. So what we really have here is the ultimate narrative tension: the herd versus the lone wolf. Momentum feeds on upward trends and high liquidity. It loves a smooth, fast market. Contrarianism, on the other hand, actively feeds on panic, volatility, and market instability. But as we're going to see when we unpack the research, this isn't just a fun personality test. It ultimately comes down to the cold, hard mechanics of how markets actually function under the hood. And to act as the referee for this matchup, we're not just throwing around opinions. We are utilizing a massive systematic literature review published in the Journal of Financial, Accounting, and Economics. This study is incredible. It synthesized empirical findings from 25 peer-reviewed scientific articles spanning a full 30-year period from 1993 all the way to 2023. We're talking global stock markets here, from the US and Europe to China and India. So it gives us an incredibly robust, data-backed look at exactly when and why each of these strategies actually pulls ahead.
Look, if there's one massive takeaway from 3 decades of intense financial research, it's this: there is no single, universally superior strategy. The data flat out proves that neither is a guaranteed knockout in every single market condition. Context is absolutely everything. The success or failure of momentum versus contrarian depends heavily on market microstructure, macro conditions, the specific types of investors dominating the space, and, critically, the investment time horizon.
This breakdown is great because it shows exactly where each strategy lands its knockout blow. And I want you to really look at the time horizon variable here. This is exactly why momentum's timing so often beats out contrarian plays. Momentum exploits immediate underreactions, which generates quick abnormal returns. It's just incredibly capital efficient. Contrarians, however, are basically forced to play this heavy, agonizing waiting game for a reversal. Momentum thrives right now in bullish trends, while contrarians need the chaos of bearish reversals to eventually pay off. Let's dig into this a bit more. So let's focus on momentum's winning conditions. When we talk about why momentum timing is so highly regarded, it always comes back to that efficiency of capital. It is vastly superior in the short term. The research shows it's highly effective in liquid stocks and is literally boosted by increased investor attention. Actually, some studies even use Google Trends to prove that when public attention spikes, momentum signals get significantly stronger. You are basically riding a fast-moving train. But the glaring weakness, and it's a big one, is that it completely falls apart the second the market turns bearish. Right, now contrast that rapid-fire approach with the contrarian reality. Notice the agonizing timing required here. Contrarian strategies often demand holding periods of 24 to 36 months just to see a profit. While momentum strikes while the iron is hot, contrarians have to tie up their capital waiting for the storm to pass. That said, it is highly profitable during high volatility, and it really excels in markets that are dominated by retail investors who are, well, prone to emotional overreactions. It's super interesting because we can actually map this out geographically, showing how structural contexts dictate the winner. In highly liquid, efficient markets like the United States, momentum strategies are incredibly effective in the short term. Conversely, look at the Chinese stock market. It has historically high information volatility and a massive dominance of retail investors who are prone to intense overreactions. So, traditional momentum strategies often fail there, but the contrarian strategy absolutely shines over that 24 to 36-month horizon.
You know, there's a pretty funny irony in all this regarding the efficient market hypothesis. That's the theory stating all known information is instantly priced into a stock. Well, if that were completely true, neither of these strategies would work at all. But as classic research from DeBont and Thaler on overreaction and Jagadish and Titman on underreaction clearly shows, human emotions create persistent loopholes. We panic and sell way too hard, creating those contrarian opportunities, and we hesitate and buy too slowly, creating the very trends that momentum investors exploit.
But I have to give you a warning. It is not all sunshine for the trend followers. There's a massive catch, the dreaded momentum crash. Because momentum timing fundamentally relies on everyone crowding into the exact same winning stocks, the downside risk is severe. When the music stops, which usually happens when the market enters a bear phase or massive institutions suddenly decide to sell off simultaneously, the losses aren't gradual. They are catastrophic and immediate.
So, who is actually brave enough to catch the falling knife during those terrifying crashes? It turns out it's usually the adults in the room. Research highlights this fascinating trend with massive institutional investors in the Netherlands, like their pension funds and insurance companies. They lean heavily into contrarian strategies during market turbulence. They intentionally buy the losers, acting as a literal stabilization mechanism for the entire financial system while everybody else is running for the exits. So how do we synthesize all this recent research? Well, the literature points toward the ultimate heavyweight technique, an adaptive switching strategy. You don't actually have to choose just one side. The most resilient approach monitors the market cycle, using momentum during bull runs to capitalize on that incredibly efficient short-term timing, and then dynamically switching to contrarian strategies to dodge those momentum crashes when bear markets loom. Modern strategies are even integrating behavioral indicators, like consistent belief momentum, to gauge exactly how firmly the crowd believes in a trend before deciding whether to ride it or fade it.
Which brings us to our final takeaway. I want you to really look at your own portfolio today. Are you acting on data-driven market context? Do you even know if you're swimming in a liquid, momentum-friendly market right now, or an inefficient, contrarian one? Or are you just getting swept up in the noise and letting your emotions make the trades? Understanding the mechanics behind these two heavyweights gives you the power to choose your battles and your timing wisely. Until next time, keep questioning the consensus.